Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. What if I told you that a single company in India holds the credit data of roughly 10% of the country's entire adult population? A company that started as a simple consumer lender but has quietly transformed into a 5 lakh crore rupees financial juggernaut. Yes, we are talking about Bajaj Finance. After a massive roller coaster ride over the past couple of years, the stock is currently trading around 980 rupees to 988 rupees. But the question on every investor's mind is the best growth behind it, or is this the perfect time correction buy? In this video, we will break down their latest financials, their ultra-aggressive AI roadmap, and the management's secret playbook to see if this compounding machine can still deliver multi-bagger returns. Let's dive in. The massive FY26 reality check. First, let's look at the hard numbers. Bajaj Finance just closed its financial year on a massive high. For the first time in history, their assets under management, or AUM, crossed the 5 lakh crore rupees milestone, ending at a staggering 5,97,975 crore rupees. That is a 22.4% jump year on year. Net profits for the full year clocked in at 19,332 crore rupees, up over 15%. Even better, the asset quality is looking remarkably clean. Gross NPA sequentially improved down to 1.01%, while net NPA is sitting at a very comfortable 0.41%. But it wasn't all smooth sailing. If you look closely at the book, their net interest margins, or NIMs, compressed slightly to 9.6% due to elevated borrowing costs in the wider economy. To combat this, the company did something very characteristic of their management philosophy. They proactively slowed down their risky MSME lending to just 6% growth to flush out bad loans. Now that the cleanup is done, management says the worst is officially behind them. Management philosophy and the FinAI moat. This brings us to the real brain behind the operation, the management team led by Sanjeev Bajaj and MD Rajiv Jain. Many investors look at Bajaj Finance as an NBFC, but internally it operates like a Silicon Valley tech firm. Under their newly launched long-range strategy through 2030, they are transitioning from standard automation into a deep AI-first ecosystem. They have already deployed a dedicated team of over 200 data scientists. Get this, the company processed over 52 million customer voice interactions into text analytics just to predict credit defaults and consumer behavior. Right now, 41% of their documentation and onboarding is entirely autonomous, and they are targeting 90% automation by 2030. Why does this matter to you as an investor? Because it drastically cuts down operational costs. Management is guiding to crush their OPEX to net income ratio down to an incredibly lean 31% over the next few years. The portfolio shift? Where is future growth? So where will the future growth come from? They can't just rely on no-cost EMIs for TVs and smartphones forever. The portfolio is rotating rapidly. Their core unsecured retail book still makes up about 40% of the business, anchored by a massive 32% share in housing via their listed subsidiary, Bajaj Housing Finance. But the real rockets to watch are the new engines. Their gold loan business exploded by 115% year on year, now accounting for 3.5% of their total asset mix. Add to that their aggressive entry into commercial vehicles, tractors, and used cars, which are projected to grow at 30% to 40% in the coming quarters. They are effectively de-risking away from unsecured loans and moving heavily into highly secured, high-margin territory. Valuation? Is it cheap or expensive? Now let's talk about the price you pay. At a current price of around 985 rupees, Bajaj Finance trades at a trailing PE of roughly 32 times and a price to book value of 5.3 times. Historically, this company has commanded a premium valuation, often trading above 45 times PE. This means we have seen a significant time correction over the last few years, making the current entry point fundamentally safer. With an expected future profit growth rate of 22% to 24%, the PEG ratio sits around an attractive 1.3 times. Most major street analysts have a 12-month forward target ranging between 1,064 rupees and 1,141 rupees. banking on dropping credit costs to boost the bottom line. The biggest risk to watch: if macroeconomic interest rates remain high, their cost of funds could pinch margins slightly. The bottom line: Bajaj Finance is no longer a speculative high flyer, it is a mature, structural compounding machine. They are well capitalized with a capital adequacy ratio of over 21%. They are aggressively leaning into AI, and they are pivoting to secured assets just as retail credit cycles change. But I want to know what you think. Are you buying Bajaj Finance at its current valuation, or are you looking at newer fintech players instead? Drop your thoughts in the comments below. Don't forget to like this video if it brought you value, and subscribe for more deep dives into India's biggest wealth creators. See you in the next one.